We have a sell-off underway, 30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Dani Berger. Bloomberg Open Interest starts right now.
Coming up, stocks sliding into the weekend. NASDAQ futures leading the decline as mounting Fed fears fuel a retreat from risky assets.
And that risk aversion sweeps across markets, hitting crypto too. Bitcoin falling below $95,000 for the first time in 6 months.
Plus, the end of an era for the world's largest retailer. Doug McMillon is stepping down as the CEO of Walmart.
It's already kicking off to be an ugly day, as you pointed out, especially in tech. But I'm looking at one specific chip maker this morning, Applied Materials, because they have their own thing going on. It's not just the macro that's making them sell off 6.6% in the pre-market. They saw sales that declined last quarter. They predicted another drop in the current period, though the company says that demand will improve in the second half of 2026. But that's not enough to save them this morning.
No, off almost 7% in the pre-market. Walmart CEO Doug McMillon will retire in February. The board has elected John Furner, who's been at the company for over 30 years, to succeed McMillon. And the shares are down in the pre-market, just 2.5%, of course, in a market that's falling itself.
And let's get more on that story itself, Matt. Bloomberg's Emily Cohn covers retail and joins us for more on Walmart. Emily, do we know why this transition is happening now?
Thanks, Dani. This isn't really a surprise. I think most people who have been following Walmart. Furner has been the natural successor to Doug. The timing of it, not so much of a surprise, and the fact that it's Furner, also not a surprise. He's sort of been Doug 2.0, waiting in the wings for a while.
So in terms of performance, the shares have more than doubled in the past 5 years. I like to look at them compared to Amazon, which has only done half as well. McMillon has put this company in a good place.
Yeah, shares have quadrupled under McMillon. So some things that he's done in the past 10 years, he's transformed the stores, made them much nicer places to shop. He's taken Walmart into the internet age, become an e-commerce giant, to your point, to compete with Walmart, and they're very competitive with Walmart on e-commerce. He's raised pay for employees. He's made it a much more competitive place to work. And he's overseen the company through a lot of ups and downs. There have been labor fights. He's seen it through the pandemic. He's had a wild ride.
And I mean, just to that point, they were also one of the first companies to come out and say, look what we're doing with AI. We found use cases for it. It's also a moment where a lot of these big companies have started to announce layoffs. What does the future look like for John Furner, especially as regards to this? Is this a turning point for Walmart?
I think that's a really good point. I think Doug said it in the statement this morning. Doug's very much credited with bringing Walmart to the internet age, and he calls out Furner taking it into the next era, the AI era. We've already heard the company. Doug has said that AI will impact every job. We've seen it in the past couple of reorgs, and I think that's a good point. This is likely a turning point for the company.
All right, well, I'm sure 2.1 million employees are going to be watching this very closely. Emily Cohn covers Walmart for us on the Bloomberg News side. Now, Warner Brothers is climbing pre-market the shares as the Wall Street Journal reports that Paramount, Netflix, and Comcast are preparing bids for the company. Bloomberg Tech's co-host Caroline Hyde joins us here at the desk, and this is a company that we're kind of on jobs watch, right? Because any kind of deal will result in still a great payout for David Zaslav. He's made that his priority, but maybe it cuts for thousands and thousands of jobs.
Look, this is November the 20th that we're eyeing. This is when the bids need to be in. Already we've had 1, 2, 3 bids coming from Paramount, Skydance, and they're up to $58 billion, which is more than where we're currently trading in terms of Warner Brothers Discovery. And boy, it's leapt since that first talk of being purchased was announced back in September and reported. But I think you're right, we are on a lot of watch as to how this all shakes out. For the second time, we see a rearrangement with David Zaslav's payout. Now, initially, there was going to be a spin. We knew that they were going to be separated. You're going to have the streaming, you're going to have the movies on one side, that would be Warner Brothers, and then on the other side, you'd have Discovery Global, which would be all the TV, basically, CNN, Food Network, and initially, it was going to be that stayed, and Warner Brothers that was spun off. Now they reverse that. Warner Brothers is one that stays. David Zaslav was always going to stay there and lead it up until all the way to potentially 2030 now, is this new pay arrangement. But what if we get the auction really showing good clout? What if the auction sees that Comcast, Netflix, they want really the streaming, the movie side of the business? Paramount Skydance wants the whole darn thing. But as we know, Paramount Skydance is already laying off people. So a lot of this is going to come at the expense of jobs. I think you're entirely right.
Just in how these different things are being cut up or not cut up, I mean, does Paramount feel then more like a more natural buyer for Warner Brothers Discovery if they want the whole enchilada? They're not just looking at taking its streaming business, for example.
I suppose it's where you think the value lies, and whether 58 billion or a little bit higher than that is what you should get for the whole amount, or whether actually by slicing and dicing it, you could get an even more rich valuation coming from a Netflix, coming from a Comcast that just wants the stuff that's doing well. That's the bit that David Zaslav, of course, unsurprisingly, wanted to stay and run. It's about the movies. It's about the history. That's why they were going back to the name of Warner Brothers, because that's sort of really where you think about the iconic days of cinema in its first iteration. But then, of course, streaming has been doing well. They have been adding more people. HBO Max has been doing well. Look, Disney Plus, we just saw yesterday, has been doing well on its streaming business too. So they're the sort of firing on all cylinders. By chopping it up, you're actually going to get more bang for your buck. Who knows whether someone wants to buy the entirety of TV? Maybe someone wants to pluck away at CNN. Maybe someone wants to take some other parts of the business. It's really interesting as to what this auction is going to shake out.
And the saga continues. Caroline, thank you so much. Bloomberg's Caroline Hyde. Now, elsewhere, Applied Materials, we mentioned at the top of the show, they are falling after seeing their sales decline, despite the fact that they are predicting a turnaround next year. Shares down nearly 7%. Bloomberg Tech co-host Ed Ludlow joins us now. And Ed, I guess it might be a little bit hard to distinguish because all of tech is selling off in a big way today. So just how negative were these results that, again, are resulting in the reaction we're looking at pre-market?
Negative, or there's no good news to reward them, right? Applied Materials has a China problem. If you look at an SPLC on the Bloomberg, 20% of the revenue is coming from TSMC and almost 20% coming from Samsung. And they cannot send their chip-making equipment into China in particular. Gary Dixon, the CEO, told us in an interview that's the issue here. Those fabs are a Taiwanese company and a Korean company, but they still have a footprint in China. And that overhang is still there. So they'll have 2 consecutive quarters of sales declines with an improving picture next year. And it makes you realize, if you run a wafer through a fab, it has many stages. Applied Materials is at the first stage where you layer the wafer, and it's at the end when you polish it. They are needed. They are essential. No one questions the big picture of what's happening in chip manufacturing at the cutting edge and the supply constraints that are there. It's just a China market issue.
Well, this is, to me, Ed, this reminds me a little bit of what we had yesterday with the memory chip makers, right? It's a commoditized piece of the process, and you had bad earnings out of, I believe, a Japanese company, and that brought down the entire. But we're going to need these commodities, especially if we continue to refresh products at the pace that NVIDIA has been.
Well, in that specific instance with Koisha, which impacted some of the American names like SanDisk, for example, we're distinguishing between highly commoditized cyclical markets in legacy memory separate from high bandwidth memory that goes into data centers. And actually, that probably makes it a more interesting economic indicator. Before all this AI stuff, we used to track the memory markets because they were cyclical and highly commoditized. It gave us a lens into all sorts of end markets and the health of the global economy. So that was an interesting warning signal to track.
I mean, I made that point because I've learned all about this from you, Ed, so I appreciate the education in high bandwidth memory over the years, as well as NAND and DRAM. In terms of the refresh cycle, though, it's been pretty quick, right? NVIDIA goes from Hopper to Blackwell to whatever's next. And this is an interesting argument that Michael Burry has been making. If the cycle is so fast, this refresh cycle, why are big companies like Meta lengthening out the accounting standards that they have for useful life from these products?
Yeah, I'll go with NVIDIA's answer to that question, which is NVIDIA commits to an annual cadence of a new GPU. So every year they have a new one. But they will tell their partners and customers 5 years in advance what their plan is. That gives the Meta in whatever example, time to plan that data center capacity, and also know that if they build a data center, 12 months from it starting to operate, the design of the technology allows you to pull out the tray, swap out Blackwell, the prior generation, put in the new generation. To NVIDIA's mind, that's what's happening. At the end of the day, next Wednesday, when they report earnings and they give a forecast for the current period and maybe beyond that, either they're right or they're wrong, because it will show up in their sales if people are willing to upgrade from prior generations of accelerator to a new one.
All right, Ed, thank you so much for that. That is Bloomberg Tech co-host Ed Ludlow on a very bad day for tech. Let's look at the overall market at the moment, because we're on track for 2 weeks of consecutive losses. For the S&P, that would be the first time it's done so since March. We're down just under 1% for the futures session. NASDAQ 100 futures, those are down 1.4%. For the NASDAQ, it would be the fourth consecutive day of losses. So it's tech that's been underperforming, whether it's the Fed, whether it's been AI fears, lots of bearish narratives swirling around markets.
Yeah, there is a lot going on. Let's take a look at some of the individual movers on our radar. We have NVIDIA down, we have Tesla down, we have Palantir down. So you can see the tech trade, as you pointed out, is really weighing on it. And of course, some of these are incredibly heavy companies,
yes,
really weighing on the index.
Yeah, man, Palantir, difficult run since their earnings. One of the rare gainers today, though, Gap, it raised to a buy at Jefferies. They said that there were encouraging trends that should help top and bottom line growth.
Merck & Co., American Merck, agreed to acquire the biotech company Cidara Therapeutics, which is developing a flu treatment. And as a result, Cidara shares, the whole company's market cap has more than doubled.
Coming up on the show, Bitcoin on the verge of wiping out its gains for the year. We're going to talk crypto. That's coming up next. You're watching Bloomberg.
Let's get now to high interest. Look what's making headlines around the world. Iranian forces have seized an oil tanker sailing in the Gulf of Oman, steering the vessel towards Iranian waters after it passed the Strait of Hormuz. The ship lost contact with its manager, and U.S. officials say the seizure violates international law. It's the latest sign of rising tensions and adds to concerns that Iran is once again targeting merchant ships as it becomes increasingly isolated by its conflicts with the U.S. and Israel. President Trump is moving to slash food tariffs and strike new trade deals with Argentina, Guatemala, El Salvador, and Ecuador, all aimed at bringing down grocery prices. The White House says the cuts will target everyday staples like beef, bananas, and coffee. The push comes after Democratic wins in key local races that focused on the lack of affordability. Meanwhile, U.S. Trade Representative Jamieson Greer says the U.S. and Switzerland have essentially reached a trade agreement to lower tariffs on Swiss goods to 15%. The White House plans to reveal details on that today. And Brandon and Kyle Lutnick are putting their stamp on Wall Street. The sons of Commerce Secretary Howard Lutnick now run Cantor Fitzgerald, and they're on pace for a record $2.5 billion in revenue this year. The bank has surged to the top of IPO and crypto deal rankings and has expanded across the U.S. from New York to Abu Dhabi. The brothers dismiss talk of Washington favoritism, saying Cantor's surge stems from smart bets on tech, renewables, and digital assets, not, Dani, not closeness of their father to President Trump.
Okay, that's according to the Lutnick brothers. Let's move something else that is closely associated with Wall Street, but some of the crypto-related stocks this morning, they have been plunging as Bitcoin falls on this Risk-Off Friday. Joining us now on this and other stories is Bloomberg finance and crypto reporter Emily Mason. Emily, it's a feeling that cash is king once again today. So what's behind some of the deterioration in sentiment that we've seen for some of these companies that are now trading below the levels that they were post-Liberation Day?
Yeah, I mean, I think with the crypto markets, especially Bitcoin and Ethereum and the altcoins, sentiment changes can show up more dramatically just because there aren't as many institutional players involved, and that kind of shows up as dramatic swings, and then that bleeds over into equities that are linked to the crypto markets.
I started out covering Bitcoin as not a joke, but as kind of a cultural exercise, like 12 or 13 years ago, by only using Bitcoins instead of dollars for my daily transactions over a couple of weeks. It was pretty fun. But back then, the whole culture, we would like meet in bars downtown, and everything was, libertarian or kind of a revolutionary kind of feeling. A lot of it was offline. That has shifted so much to the sort of corporate-based, Washington-centered, we want to be regulated ethos in crypto. Everything has flipped 100%.
Yeah, I mean, Bitcoin, people who really believe in it, Bitcoin maxis want it to be used for everyday transactions, but one of the issues is like the price is volatile, so you don't want to pay for something today and then, the Bitcoin is worth a lot more and you overpaid for it. So that's kind of where like stable coins came into play, because they're going to be worth today what they are tomorrow, so you can kind of trust it as an everyday currency.
Well, how much of that is exemplified by Jack Dorsey, that's starting to steer Block more towards stable coins and away from Bitcoin, who he was the evangelist for Bitcoin, and exactly kind of what Matt was talking about.
He was the guy that we were hanging out with in bars downtown,
Right. No, and he still is like a huge Bitcoin believer, and I think their end goal is still that like Bitcoin is a currency that people are using every day. It's still something that they're investing in, but I think this is them recognizing that the momentum in the market right now is around stablecoin, and that's what people want to use, so they kind of need to support it, and that's kind of a big break. Like Jack's ex-bio is still no state is the best state, and like that's still the world that he's kind of working towards.
No state is the best state. There's no government like no government. Used to be the bumper sticker on my old Volvo. But crypto has moved from like rage against the machine to just a big piece of the machine, right?
I mean, that's kind of the direction it's had to head in. Like the stablecoin issuers are applying for national trust bank charters. They're trying to comply with the Genius Act. Like they're really trying to like move under the regulatory umbrella. And that's kind of stands in contrast to the original ethos of Bitcoin, which is sort of decentralization. Like, we don't really need to trust each other. We can rely on code. And that's very much Jack's personal philosophy. And so I think they probably see adding stablecoin support as potentially a stepping stone. And they've said that Cash App and Square are going to stay Bitcoin first by design.
Hey, Emily, thanks for joining us this morning, and a fantastic story on Jack Dorsey. Really recommend everyone go and read it. That's Emily Mason from the Bloomberg Crypto team. And Bitcoin is falling this morning, trading at its lowest since May. Reflecting what we're seeing in markets elsewhere, for the NASDAQ, this would be the fourth consecutive decline. Matt, it is this feeling that dip buying, which has worked so well this year, kind of has had its first real test, that buying the dip this week so far hasn't paid off.
What is it? The first back-to-back weekly losses since June, right?
Since March for the S&P 500.
All right, since March, so going back even further. Coming up, Morgan Stanley's Jim Caron says 2026 will bring a stock rebound driven by tax boosts, corporate investment, and AI-fueled productivity. We'll ask him about the depreciation schedules. This is Bloomberg Open Interest.
Famed Big Short investor Michael Burry is questioning whether big tech's profits are overstated. He alleges that lengthening depreciation schedules from big AI spenders is, quote, one of the more common frauds of the modern era. He estimates that hyperscalers will understate depreciation by $176 billion through 2028. Joining us now is Morgan Stanley Investment Management CIO of Cross Asset Solutions, Jim Caron. Jim, maybe it's telling that he thinks this, but he had to close his hedge fund. Even so, tech used to be these magical unicorns where investors didn't even need to think about the balance sheet except to say, hey, your cash is piling up nicely. We would like some of that. Is that era permanently over?
Well, first of all, good morning, and thank you for having me on your show. I don't think the era is permanently over, but I do think that we're moving into a later cycle of this where you're seeing debt become a bigger part of the equation. It's not just funding things and investment out of cash perpetually. Now I think debt is playing this. This is a natural part of the cycle. But what we also have to recognize is that when some of these big tech companies, like we've seen over the past few weeks, raise money, they are going to spend that money. They are going to continue with the business investment, with the CapEx. So that they're not raising this money just to save it, right? So essentially, if we think that GDP growth was driven by, in many ways, CapEx and business investment from these large tech companies, I still think that's on the table for 2026.
It is telling, though, that these companies, like Meta, are saying, hey, these chips and servers that we thought previously would be only useful for 4.5 years, now maybe they're going to be useful for 5 or 6 years. And it just doesn't jibe with the way I think of the modern technology refresh cycle, right? I'm not going to buy an iPhone as a tech company and then use the same one as 5 more come out. I'm going to buy a new iPhone every single cycle.
Right. So I think what you're saying is that we're violating Moore's law by saying that essentially that things do become more efficient over time. And I think that's somewhat speculative. People talk about the shelf life of some of these technologies, and I think they always tend to overestimate what these things are. New innovations come up all the time, and I think that what people are betting on, what investors are betting on, is that many of these tech companies and even the end line users of these are always going to want to have that technology efficiency and want to stay in front of it. And I think that the stock market will penalize the companies that aren't really doing that. So I think the investment's going to be there. I don't see that going away anytime soon.
All right, Jim, you're going to stick with us. More to discuss, especially as this entire sector sells off this morning. But a lot of narratives all pushing us in the bearish direction, though. A check on futures this morning ahead of the opening bell, only under 5 minutes to go until then. Still a tough session, a tough way to end the week. We're down nearly 1% for the S&P. The NASDAQ, Matt, falls 1.4%. It's not just the question of the AI, it's also how loud hawks are right now at the FOMC. That's really punishing the market.
Absolutely. Those who were counting on rate cuts are counting on them less and less. If you take a look at WIRP Go, or if you take a look at how much the market is pricing in, it's far fewer than 25 basis points at the December meeting. We come back, we're going to have the opening bell from the NYSE and the NASDAQ. This is Bloomberg Open Interest. Moments away from the start of trading, and we are prepared for a sell-off again today. A drop for the week. 2 weeks down back-to-back. It's the worst that we've had in terms of consecutive weekly drops since at least the beginning of the summer. S&P futures down 1%. NASDAQ futures down 1.5%. The small caps, as the Fed gets increasingly hawkish, also getting hit down 1.5%. It's like power day when it comes to ringing the bell. We got a couple of power operators here. Vertiv ringing the bell at the New York Stock Exchange. I'm pretty sure based in the great state of Ohio, because we had that CEO on before, and I think he was out of Dublin. And then you've got Terrestrial Energy, which the ticker is IMSR, for an integral molten salt reactor, which sounds like awesome power technology. The AI power trade, Dani, the AI industrials trade all took a huge hit yesterday, and that looks to be continued today. Yeah, it absolutely does. And we have some weak earnings that have really just fed into that. Applied Materials being among them, shares down here at the open more than 7%. They saw sales decline last quarter. They also predicted another drop in the current quarter. They did say that demand will improve in the second half of 2026, but there's just so much skepticism right now, Matt, that that's not enough to revive these shares. All right, we also have news in, I guess, the old economy, although CEO Doug McMillon at Walmart has quadrupled the value of this company under his leadership by bringing it into the new economy, bringing it online using AI and such. He is going to retire now that he's approaching the ripe old age of 60. He steps down in February. The board has elected young John Furner, only 51, who has been at the company, though, for over 30 years, to succeed McMillon. So right now, Walmart shares down 2.8%, but it's a down market. I'm not sure how much you can read into that. Let's bring back in Morgan Stanley Investment Management CIO of Cross Asset Solutions, Jim Caron. And Jim, we touched on the depreciation schedule, and I'm sure what you can get back to AI, but I just want to ask quickly your view on the Fed. It seems in a little bit of disarray, speaking of the FOMC, right? It doesn't seem as though Chair Powell really has control of the committee right now. What do you expect in December?
So I expect them to cut 25 basis points. And quite frankly, I think the market's getting this wrong. And I know that some of the statistics for a rate cut are starting to fall in, for the December meeting. But my view on this is that when the government reopens, which it's reopened, and the data starts to come out, it is only going to bolster the argument for a rate cut. If the Fed has been cutting rates in the past when the data wasn't as weak, when I think the data does come out, I think it's going to show substantial weakness, particularly in the labor sector. I mean, we've seen all these announcements for layoffs and things like that. So how do you sit on the Fed in the face of all that, knowing now that the labor market is absolutely deteriorating? And inflation doesn't seem to be running out of control. In fact, the latest data print that we've gotten, has been a bit softer. How do you not, if your dual mandate is labor market stability and price stability in inflation, how do you not continue to cut interest rates in this environment? So I'm really pushing back hard against this view that there will not be a Fed rate cut in December. I absolutely think that there will be.
Maybe the way that you don't cut, Jim, is because you're trying to show that you won't cave into a Trump appointment who will be pushing for cuts come 2026. That's not necessarily my view. Krishna Guha at Evercore has been writing about this, some very strong words, saying the debate in and around the Fed has taken a worrying turn, that usually the process of building consensus has broken down, and says this feels like a dress rehearsal for 2026 with officials digging in against a default to cut under a Trump-appointed chair. Jim, could that be behind some of the hawkishness we've heard from Fed officials, and what would that mean for next year?
So I mean, this calls for speculation, right? I think that there might be some posturing with some Fed officials around this before the December meeting. But at the end of the day, the Fed is framework driven. Their primary framework that they look at is something called the Phillips curve, which is the relationship between the unemployment rate and wage inflation. If the unemployment rate is going higher and there's more supply of labor coming into the markets and wage inflation is coming down, then therefore goods inflation will also come down. Then that is a signal for them to cut. Their framework will be flashing red for them to cut interest rates. So whatever the posturing is, they would have to really bring a very good argument as to why they're going to abandon that previous framework. So I don't quite see it. Maybe it's just talk and rhetoric, but I don't quite see it, and that's why I'm very confident about a rate cut in December.
What's your take on the broader economy, Jim, and credit right now? Because we've seen some blow-ups, cockroaches. I'm pretty sure Jamie Dimon was referring to them as, although the private credit guys that Dani has been talking to are all saying, like, we're so good at
We're not the
analyzing
cockroach,
risk.
you're the cockroach.
There's no cockroaches here.
Yeah.
But the consumer has had a really tough time. More than 40 million on food stamps. A lot of them didn't get all of that food support through the shutdown, which was the longest in history, and we're starting to see more auto delinquencies than ever before since record keeping began. Isn't this a concern?
It's absolutely a concern, and it's why the Fed should be cutting interest rates. So the way that I would think about this is effectively we are in a soft patch for the economy right now. We have, by the way, been in a soft patch for the last several months. And Dani and I have spoken about this. The market's not the economy is not the market. So essentially, the markets had powered ahead despite some of the weakness that was already existing in the markets. In the economy. So sometimes the markets and the economy do overlap and intersect, and that's what's happening today. As we get the data releases, people are jittery, people are nervous. Prices and valuations have moved very aggressively higher, particularly in the third and fourth quarter, which means that the markets are fragile to any bad news. And that fragility is what's being seen right now. Now, the question is, does that change the trend going into 2026? And no, I don't think it does. Because most economists are still forecasting higher GDP growth in 26 versus 2025. And I think that's going to support earnings. Also higher productivity. So a lot of the onboarding of this CapEx and technology and everything else is bringing higher levels of productivity into the markets. This labor force now that seems a bit more abundant should mean that you can get labor at a reasonable price, which means that companies, in terms of their expense on labor, should be, relatively stable. and essentially allow profit margins to continue to widen. So I think the markets will be supported. I think this is a buying opportunity. I don't think this is a change in trend, but it is turbulent right now, and we expected that for the fourth quarter.
Can we just talk about exactly what that turbulence will look like over the next 2-3 weeks, Jim? Bloomberg Intelligence puts it as thus. Bond trader hell is coming. 17 days and the mother of all data dumps, because we'll get the September PPI, retail sales, October CPI, September and October payrolls report, although maybe not the complete picture. Oh, and by the way, NVIDIA earnings too next week. Just what are you bracing for, Jim?
So I think everything that you just mentioned is very well anticipated by the markets. I'm anticipating that the data releases are going to be not very good. I think the data is going to show significant weakness. And I think that's what the markets are pricing in right now. So the question is will the data be weaker than what market participants are currently pricing in at the moment? Or might they be a little bit better? And then that's where the surprise is going to be. But I'm firmly in the camp that fourth quarter is really the trough of the soft patch. And this is where we're going to get that data dump. Let's rip that Band-Aid off quickly. Let's get through this, and then let's start to focus into 2026. But we have to get through this data dump first, and that's what's causing the markets to have a lot of jitters.
We'll all hold hands and jump together into the data dump fog. Jim, thank you so much. Morgan Stanley Investment Management's Jim Caron. Let's get a check on this equity market, headed for another down day. It is the fourth down day in a row for the NASDAQ, for the S&P, the second consecutive down week that we're looking at. We're down about 0.8%, so not as bad as we were in the future session. Some of the energy companies, GE Vernovia doing better, Micron doing better, Berkshire Hathaway. Warner Brothers Discovery is on the plus side because there's reporting that the takeover interest is really started to come to a head with Comcast, Netflix, and Paramount. Now, on the downside, the more important one this morning, because this is what's dragging the overall market down, it is a Mag 7 tech flavor. NVIDIA, Broadcom, Tesla, Alphabet, Amazon, Apple, Meta. It's one, are we going to get those Fed cuts? Jim Caron says yes. But two, is the AI trade, are we really starting to question it? And the amount of spend that's coming from these companies and the depreciation costs racking up, per the words of Michael Burry. Let's look at what we've had so far this week in terms of sectors. Actually, this is, 5 days. Consumer discretionary, one of the worst ones. I guess we've had some earnings there that haven't been great. Infotech, no surprise, that's down 1.2%. Healthcare, so real safety play up at the top. Healthcare up 3.7% rather, followed by materials and energy, Matt.
All right, so that's the setup for a down day. Walmart also falling after announcing a new CEO, maybe because the outgoing CEO did so much for shareholders. We'll talk about what the new CEO can deliver with Telsey Group's Joe Feldman. This is Bloomberg.
A tough morning this morning with markets down across the board. Let's see what the analysts are saying. Some of your top calls this morning. First up, Stubhub failed to issue a fourth quarter forecast in its first earnings report since going public in September. Bank of America cut its rating on the ticketing platform. Analysts at JP Morgan and Evercore also say that decision to hold off on guidance plus softer ticket sales is fueling concern. Concern is big this morning, down 24%. Next up, Home Depot, that gets downgraded at Stifel. The analysts say that the home improvement demand looks stagnant and may even be weakening, and they see a delayed recovery for the sector. Home Depot, will hear from them on their earnings next Tuesday. Those shares down 1.5%. Finally, the Gap gets upgraded to a buy at Jefferies. Jefferies says that management has driven a strong turnaround at both Gap and Old Navy. They see significant upside in beauty at Gap and say that Wall Street underestimates this opportunity. Shares are unchanged, but in today's market, that's probably a good thing, Matt.
Yeah, unchanged is better than dropping with the rest of, I guess, with the tide. Walmart shares are doing that after announcing a successor to CEO Doug McMillon. Telsey senior analyst Joe Feldman has an outperform rating on the stock and says the incoming CEO, John Furner, is the logical choice to run Walmart. So, Joe, I wonder if I can first ask you, these shares, the share reaction that we have, is that disappointment that Doug is leaving, since he's done so much for shareholders, really, and employees at Walmart during his tenure, or is this, the boat sinking with the tide?
No, I think it's the first thing you said. Doug has done an amazing job, Doug McMillon, that is, as CEO of Walmart. You know, the stock's up like 400% since he took over in February of 2014. So you could see, you know, investors really liked him. He's turned around that business. He's transformed it. He's modernized the supply chain. He's, you know, there's brought a lot of digital and technological innovation to the company. And that's really what's propelling it right now. You know, in addition to obviously being the lowest price provider for retail goods to consumers. So like you add that all up and people, why would anybody want that to change? So I do think the transition to John Furner is going to be relatively smooth. He's a lifer at Walmart, very much like Doug McMillon was. And I think he's really ready. He's been running the Walmart US business for the past several years, and it's done phenomenally well under his stewardship.
And what a year it's been for McMillon after getting Walmart to the place it is. I mean, now he's someone who had to deal with President Trump directly lashing out at him for saying that Walmart would be raising prices because of tariffs. In John Furner, how much is this a man who not only is going to have to continue to carry the torch from what he's been doing at the U.S. group of Walmart, but also needs to become a diplomat of sorts, needs to become a figure that can handle President Trump, just given the prominence of Walmart in American society?
Yeah, you know, I think John Furner is really ready and up to the task. You know, he's been groomed really to become the CEO. Walmart does a very good job of leadership and transition planning. This wasn't a very quick thing. This is something that's been in the works for a while. He's been mentored by Doug McMillon for years. And, you know, so I think that that's going to really help him go forward. He's got a great board that's around him to help advise him. And I think John, he does a very good job. He's very diplomatic. And I think that he's the right guy to bring, you know, Walmart into the next decade, really, because that seems to be what they do with their CEOs. And, you know, that's what we're going to be looking at, is to see how he can help really fuel this continued transformation of the business and really embracing the technology. I think he's up to the task of dealing with leaders of foreign countries and our own country.
I wonder about the, you know, 2.1 million employees at Walmart. They've arguably done better under Doug McMillon's leadership, right? He's raised the pay that they get, but they've got to be fearful that, at least in some cases, AI could replace their jobs, right? You're never going to not need greeters, I hope, at the door, but a lot of the other jobs there can be done by AI. How fearful do you think they need to be of layoffs under this new CEO, Joe?
Well, I'm not so sure we're going to see layoffs, but we could see, you know, the labor pool stagnate around this 2.1 million, where you don't see a lot of new additional labor. And I do think the role that people play at Walmart will transition and change. You know, Doug McMillon has talked about that quite a bit, that he feels like we don't necessarily need to reduce the labor force. It's much more about just transitioning the labor force to embrace new roles and the technology that's coming to be more efficient. They're already starting to do that. I think John Furner is probably going to take that same approach. I think that, you know, they've done a really good job with both John Furner and Doug McMillon, both starting at the company as young men right out of school, hourly employees, rising all the way to the top. I think that's a great example for others at Walmart, and to show that Walmart really does like to promote from within. And people are immensely important, especially in retail, as you said, you know, to greet customers, to make sure that there's good customer engagement and that you're doing the right thing for the consumer.
Joe, really great to get you on this morning. That's Telsey Group's Joe Feldman. Just to check on markets, because we were speaking with Jim Caron in the last 10 minutes, and he said this is a dip he would buy, and buying we are doing. NVIDIA surging at the open, erasing its losses. It's now positive. Just moments ago, I was looking at the stock, and it was down nearly 1%. S&P 500 now is trading down only about 0.5%. The Nasdaq down 0.7%. Matt, it also looks like a lot of these memory chip stocks, like Micron, is surging too. It's up 5% after it initially opened down. So people are rushing to buy this dip at the very moment.
I was going to say, so much for questioning the buy the dip narrative.
I should have known. I shouldn't have questioned it.
You spoke too soon.
I did speak too soon.
Dani. Although I think it's still interesting, and we'll continue to pose these questions about the depreciation schedule, because Michael Ball from the MLive team writes that the growing importance of power efficiency and data centers really changes the depreciation story, right? If you make chips that are twice as efficient as the previous version, everyone's going to have to go into these data centers and change out those chips, open up the servers and replace the millions and millions of microchips that are going to be put in the, tens of thousands of data centers being built across the planet right now.
It does speak to this overall story. Tech used to be asset light, and that's why people used to love it. And that just speaks to a facet that has completely changed, and the business model is very different now.
There's so much to talk about on this Friday. Coming up, Vanguard is on pace to set a new all-time record for ETF inflows this year, surpassing the record that it also set back in 2021. We'll look back at the year that was on ETF Friday next. This is Bloomberg Open Interest.
In what's been a wild year for markets and ETFs, one firm stands above the rest. It is Vanguard that is on pace for an all-time high in ETF inflows, even as a new generation of high-octane launches gains traction. Joining us now is Athanasios Saravegas, ETF analyst for Bloomberg Intelligence. Athanasios, on one hand, okay, it's not surprising. Vanguard is like the company. It offers cheap ETFs. It's been the leader in this. But as I mentioned, there have been a lot of challengers coming in and putting different types of funds into the markets. What's allowed Vanguard to retain its crown?
Yeah, I think, it's very easy to get sucked into these new launches, right? There's crypto and leverage. And so I think how issuers are learning to sort of position themselves is we can't go head to head with Vanguard. Their value proposition is way too strong. They're cheap. They offer plain vanilla exposure. So we're going to learn to live alongside them. And if you kind of see how flows are going, the middle of the road is very difficult. It's on one end, you have your cheap core holdings. And on the other end, you have more of your speculative bets like the crypto, like ARK and things like that. So it's also like a nice sign that yes, there's all these crazy launches, but most of the money does tend to still go to these plain vanilla type ETFs. So I think that sort of keeps at bay some of these fears that, the market's gonna get sort of off the rails or there's gonna be issues with products, but just below the surface, it's still nice to see that most of the stuff does go to pretty traditional investments.
So plain vanilla ETFs, what, like just straight up passive index trackers? Because I thought from my days a few years ago of co-hosting ETF IQ that we were going to see a huge wave of active ETFs almost push those passives out of the market.
Yeah, I mean, there's definitely been, most of the stuff that comes out now is active, and even Vanguard, to be fair, is looking at active now, but it's been a really tough proposition to get money away from Vanguard, only because the S&P's also been really great too. So if you've just been putting money in the Vanguard S&P fund, you've had a great couple of years. So that also helps too. Maybe if the market conditions change and does active start to do better and maybe more difficult markets, maybe we can see that change. But again, I just think the value prop is way too strong to be able to dislodge those assets from them. And that's why they keep growing. You have on one end, launches are taking off. We have almost 1,000 ETFs this year, but Vanguard still is kind of just doing its thing, and they're going to, again, set a new record for any issuer in terms of assets coming in.
All right, Athanasios, thanks so much for joining us. Athanasios Saravegas of Bloomberg Intelligence, part of the triumvirate that runs our ETF coverage on the print side. We've got Eric Balchunas, obviously James Seyfert and Athanasios. Tune into ETF IQ with Scarlett Fu Mondays at 12 noon New York time to get more on this ever-growing asset class. Coming up in the next hour, Paisley Nardini of Simplify Asset Management explains what catalysts aside from AI and the Fed are needed to keep stocks afloat. Plus, Churchill's Kencel on their year-to-date performance in the middle market business, and the CEO of Bentley is in the studio to unveil its newest model, the Supersports. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Dani Berger. The worst of the losses for the S&P turning around as dip buyers emerge for NVIDIA and other big tech stocks.
Coming up, the relief brought by the end of the government shutdown gives way to volatility as a host of Fed speakers throw cold water on a December rate cut.
Meanwhile, President Trump is preparing major tariff cuts as he seeks to address voter concern over the cost of goods.
And Cantor is having its best year on record since Howard Lutnick left to join Donald Trump in the administration and his sons took over. That's a big story that we'll bring you this hour. But we begin with famed Big Short investor Michael Burry questioning whether big tech's profits are overstated. Jim Caron of Morgan Stanley weighed in.
When some of these big tech companies, like we've seen over the past few weeks, raise money, they are going to spend that money. They are going to continue with the business investment, with the CapEx. So that they're not raising this money just to save it, right? So essentially, if we think that GDP growth was driven by, in many ways, CapEx and business investment from these large tech companies, I still think that's on the table for 2026.
Joining us now is Paisley Nardini, Simplify Asset Management Head of Multi-Asset Solutions. Paisley, thanks for joining us this morning. A real question for some of these big tech names. Clearly, some sort of dip buyer has emerged this morning. But this week, when you've looked at the tech sell-off, would you recommend buying that dip?
Yeah, well, thanks for having me. Good morning. I would say this sell-off that we've seen in risk assets over the last couple days, in context of where we've been over the last few months, I think makes sense. It's a bit of a breather. Anytime markets are digesting information, because we're at this precipice of we keep marching higher. Valuations are full, risk assets broadly, even in non-risk assets. This rising tide has lifted all boats. And so some of the sell-off we've seen over the last couple of days, again, I think is healthy. I think it's just a bit of digestion, and some of the Fed rhetoric and speak around December rate cut makes sense in light of that. Without that additional monetary easing and support, markets are right to kind of take a step back and digest where are we headed over the next couple months.
Paisley, are we really, though, not going to get that? I mean, even if we don't get a December cut, isn't it pretty clear the direction this Fed is heading, especially when, President Trump gets to install the yesest of yes men coming up soon as chairman?
Yeah, I would say you're right. I think as we look forward and the expectation that markets have priced in for future rate cuts, the Fed doesn't really want to deviate too far from that because they know if they pull the rug out on the expectations, markets are going to go haywire and no one wants that. I think it is right, though, for the Fed to pause and think about December rate cut, just given the data that we've seen doesn't show meaningful cracks. And actually, we've had a lack of data. And so if the data wants to maintain this independence and data dependency in how they manage monetary policy, they're probably right to at least pull back on some of the definitiveness of what a couple weeks ago we were expecting for that December cut. I do think, though, Matt, to your point, looking forward, we'll remain on this trajectory of 2 to 3 rate cuts over the next probably 6 to 12 months. But that's where the risk, I think, lies within markets, is markets are expecting that, pricing that in. And if we see either more cuts or less cuts, that's where the volatility tends to come from.
Paisley, I understand the debate of just trying to figure out how many cuts we're going to get, but isn't something bigger happening? At the moment, you have hawks on the FOMC who have been incredibly vocal in a way that feels rare and split from recent history when you had a Chair Powell who had this power of coalescing a Fed. Is there a real concern that heading into 2026, you're going to have an increasingly divided Fed that doesn't have that coalition? And how will that change volatility in markets and just how you think about Fed speak and what it does to various asset classes?
I actually love that you asked that, Dani. That's something I was thinking about the last few days, is this polarization from a political spectrum that we've seen and just kind of day to day is now infiltrating this, what is supposed to be a political body of decision makers. And so I think you're absolutely right. If we start to see the polarization, we have, Stephen Mirren on one end that's ultra dovish. And then now we have several people, including Neil Kashkari, coming out and saying, wait a minute, we shouldn't have cut at the last meeting. We definitely should not have cut going forward. So you're right. That polarization, I think, will lead to more market volatility. And I think it will also start to have the market look at the FOMC meetings and the Fed body and say, is this really the best indicator of where markets are headed? And so that validity or that credibility that they hold or have held historically, I think starts to come into question.
Nonetheless, this rally that we've seen, this year and honestly last year, maybe even the year before, is not built on any Fed cuts per se, but really the if you build it, they will come narrative for AI, right? How confident are you, Paisley, that this $1 or $2 or $5 trillion build out will be justified by profits over the next, say, 5 years?
Really interesting point, because what we've seen is the anticipation or the expectation of AI coming to market, infiltrating down into some of the more, mid and small cap parts of the market, should kind of rising tide lift all boats. And I think now, again, we're at this precipice where we're really starting to dive into the numbers and look forward and understand the expectation going forward. In order for markets to continue to march higher, we'll have to continue to see greater improvement of margins, greater productivity, and that becomes an increasingly hard hurdle to pass. I do think that we are starting to see some of the infiltration of the benefits of AI build out in commodities per se. I know commodity markets have been a bit of a snooze for the last couple of years, but we've started to see through precious metals and industrial metals, and even some of the recent uplift in oil and gas start to boost that. But you're right. I think we're all kind of waiting with bated breath for every earnings report. And of course, NVIDIA coming out soon here. It is something that markets will have to digest. But ultimately, what this means from our perspective is how do you diversify those risks so that you're not exposed to a single earnings report or a single data point as to whether or not your portfolio is resilient?
Paisley, what do you think will be more telling for the market next week? Is it NVIDIA earnings or the beginning of the data dump to make up for everything we missed out during the government shutdown?
I think NVIDIA earnings are always at the forefront of everyone's understanding of where markets are headed, because it is such a large part of every index and everyone's individual portfolios. So provided that's a semi-non-event, I think you're right. Thinking through that, the next step, of course, is that December rate cut. I'm guessing that we'll start to see the expectations of, a cut at that meeting start to move around quite a bit. And so as we start to collect and see what this data has maybe provided us for the last couple of weeks, I think that will be the kind of cursor heading into year end, what will drive markets.
All right, those NVIDIA earnings coming on Wednesday of next week. Paisley, thank you so much for joining us this morning. Wonderful to get your thoughts. Paisley Nardini of Simplify Asset Management. And a check on markets, as we were just showing you, NVIDIA flipping back and forth between negative and positive, but just the fact it's not losing as much steam as it was yesterday in pre-market is lifting these overall markets. At one point, Matt, during the futures session, the NASDAQ was down 1.5%. Now, for both indices, we're down just a little bit more than 0.5%, so the dip buyers have emerged.
Yeah, it looks like they're here, but not completely, right? We're still going to be down for the week, and it'll be the second week in a row of losses. We haven't seen anything like that since the beginning of the summer. Let's get a look at some of the single stocks moving at this hour. Applied Materials reported a sales decline last quarter and predicted another drop in the current quarter, and as a result, that stock is down, but only 1 2/3%.
What is higher this morning is Warner Brothers Discovery. The Wall Street Journal reporting that Paramount, Netflix, and Comcast that they are all preparing bids for the company. Those shares up 2 3/4%.
And Walmart announcing CEO Doug McMillon will step down in February and be replaced by John Furner, who's been at the company for over 30 years. This was widely seen as Furner was widely seen as a good replacement for Doug, but the latter has done so much for the share price that the market seems a little bit disappointed.
Yeah, huge returns from Walmart off the back of that. Okay, coming up on the show, Ken Kencel of Churchill Asset Management will be joining us to discuss today's investment dynamics and what he sees as resilience in private credit. That's coming up next. You're watching Bloomberg Open Interest.
Getting out of high interest, look what's making headlines around the world. President Trump is pushing a wave of tariff cuts, I should say, to tackle high grocery and consumer prices. The U.S. has struck new trade deals with Argentina, Guatemala, El Salvador, and Ecuador to lower the costs on beef, bananas, and coffee, and essentially sealed an agreement with Switzerland, slashing tariffs there from 39% to 15%. In return, Switzerland will invest $200 billion in U.S. manufacturing and pharmaceuticals. The White House says it's all part of Trump's drive to make America affordable again. And Bitcoin slipped below $95,000 for the first time in 6 months as investors yanked nearly $900 million from Bitcoin ETFs, the second biggest outflow since their launch. The token is now close to erasing all of its 2025 gains, with more than $1.3 billion in leveraged bets wiped out just in the past day. Liquidity has thinned, and the sentiment is souring as traders question whether the Fed can justify rate cuts. Tens of thousands of travelers are suddenly losing their global entry status, often with no explanation. Data from Customs and Border Protection programs show revocations dropped 47% last year. The program, which speeds entry for low-risk travelers, is supposed to drop people only for crimes or customs violations, but some say they were flagged over small issues like online shopping. The CBP has not explained the surge. Dani?
Confused why online shopping would mean you lose your global entry. Presumably, like, you're buying something from China, right? Or a different country? I don't know.
No
Weird.
idea.
Weird. Anyway, let's turn to something maybe we can understand better. Private credit, where heavy hitters from Blackstone to Sixth Street have recently warned that returns will narrow following years of explosive growth, and that growth has been explosive. We spoke with Akila Graywall of Apollo on her outlook.
Credit has grown tremendously, and our view is that it's going to continue to grow. Our view is that private credit is an enduring asset category, and we've expanded the definition of what that means. We focus not just on kind of direct lending. Of course, we have a big franchise that does that, but I think our leg up has really been the fact that we have an insurance balance sheet that has allowed us to originate private assets and private credit across the risk-return spectrum.
Joining us now is a man that knows this space very well, a veteran and a titan, Ken Kencel, president and CEO of Churchill Asset Management, a $57 billion private capital affiliate of Nuveen. Ken, thank you so much for joining us this morning. This weird thing is going on at the moment. Private credit is so hot. You look at your equity brethren, and there's this talk of zombie firms popping up more than ever. But private credit is so popular. You have hedge funds like Point72 and Millennium launching strategies. What do those dynamics say to you that tourists are now coming in?
A lot of tourists, a lot of new entrants. Look, I think there's room for all of the players. I look, at the end of the day, private credit, in our view, is all about differentiated sourcing, origination, and ultimately relationships, right? So I think you will have new entrants. I think there are certainly places to go with that capital. Whether those are the most optimal places to go with the capital and where they're lending, I think is going to be an interesting question. But you've got established players that have relationships built over decades, and I think those firms are going to continue to enjoy the benefits of those relationships. But the new entrants that come in, I think, will probably focus more on opportunistic strategies, areas where they can drive somewhat higher returns. Particularly if you look at hedge funds, right? That's their thing, right? They're looking for, you know, a niche or a way to drive incremental return. So I think those firms will focus more on opportunistic areas. And relationship lenders, folks like ourselves that rely on those historic differentiated sourcing and relationships, I think have a place.
Ken, just one point on that. We've seen this movie play out before. We had some of the Tiger Cubs get into private equity, for example. Yes. It didn't work out well.
Yes.
A lot of them took a lot of losses and were forced sellers into the market. Who's to say that that won't happen again if you have firms, again, whose history and credentials aren't necessarily in private credit?
Yeah. Yeah, well, I think, look, part of where I think you'll see them go is in distressed areas, you know, where they can come in and provide capital and maybe a higher risk scenario. Look, the world we focused on is more traditional, right? We're looking for high quality, mid-market businesses that are market leaders in their space, non-cyclical, where we can drive a very consistent long-term return. So you've got kind of the regular way private credit, and then you've got situational or opportunistic credit. I mean, the reality in private credit is you hear about it as a monolith, right? We're in private credit. It's venture lending, it's distressed lending, it's upper middle market, lower middle market. So there are lots of flavors of private credit. It's, you know, asset-based lending. You know, we saw with, you know, First Brands and Tricolor. So it's much more differentiated, and I think there are niches where those hedge funds will play, but it's not where we play.
You play in the middle market. The firms that you invest in here in the U.S. are $10 to $100 million in EBITDA, right?
Yes.
And I'm wondering, you know, there's two trends, big headline trends from the Trump administration. One is the tariffs, and I imagine that is much more difficult for middle market companies to deal with than mega cap companies. The other is deregulation, which must be a tailwind for middle market companies. So how do those two balance out?
Yeah, sure. Well, the interesting thing about tariffs is that when you look at our businesses, the companies we finance, exclusively U.S. companies, primarily service businesses, that interestingly have very little influence on their business internationally, right? So very, very limited, international customer base for these businesses, U.S. mid-market service companies, and actually very minimal manufacturing. So when you look at our concentration or tariff issue in our portfolio, less than 10% are really impacted at all by tariffs. So the tariff dynamic has actually turned out to be a pretty good thing for us. And in fact, our investors see that and like the fact that there's limited tariff exposure.
What about deregulation? Do your companies have to spend less to deal with that kind of compliance?
It's certainly a positive. Look, I think deregulation overall is a good thing, and certainly mid-market companies, those that maybe don't have, or want to invest heavily in dealing with regulation, I think, benefit from not having to do that. So I think deregulation is a net positive overall. The tariff dynamic, I'd also say, for us, is something that, has turned out to be even a positive from a fundraising perspective, right? I think when tariffs came in, there were a lot of questions about, oh my gosh, what's this really going to do to portfolios? And as things have played out over the last several months, investors can see that it really hasn't had a significant impact on our portfolio. So that spurred more fundraising, which is great. But I'd also say that when you think about our dynamics going forward, being away from tariffs versus the broadly syndicated market, where you have larger companies that have much more international exposure, makes us more attractive on a relative basis as well.
Ken, one of the things that makes you unique is that you're staying in middle markets, because it feels like every private credit company wants to get into big infrastructure AI, that they're all touting how great it is to be with these blue chip IG companies.
Yes.
Is this also, you may be seeing risk in there?
So,
participating in that market?
Yeah, no, it's a great question. And actually, I spoke with Romaine about this at a conference a few months ago. There was a panel talking about exactly that. The reindustrialization or the industrialization due to the data centers and how that's playing out. We did some research when I met with him in advance, because I always know what a great job he does in all of his research.
He does.
And what we found is that we have about $6 billion invested in our portfolio, not in the data centers themselves, but in companies that are mid-market companies that are supporting data centers. So I think that there's a misconception that it's just building these data centers that's driving the activity. The reality is there are thousands of companies in the mid-market that are participating in that. We finance, for example, HVAC build-out businesses, right? Well, they're supporting data centers. Food service businesses that are actually supporting the workers that are working in the data centers. So I think it's a broad-based benefit to the economy. And I think while data centers are part of it, and obviously those are the largest dollars, we're not financing data centers, but we are financing the companies that are participating in that opportunity.
You mentioned fundraising is fantastic. What do you expect in terms of growth? I know you have tens of billions of dollars under management. You have 200 employees. What kind of growth do you expect?
Well, we just finished our annual investor meeting this week. I think we had something like $15 trillion of investors participating in the meeting. So I got lots of feedback on what we anticipate. And look, I think certainly our investors are looking for a more conservative profile. There's always the risk of recessionary dynamics from tariffs. And we haven't seen that at this point in our portfolio, but I think they're looking for us to stick to our knitting. I think, 5-6 years ago, investors, I don't think, fully appreciated all these differentials within private credit. Today, they like the middle market and they want us to stay there, right? So they don't want to see us, venturing off into some of these other areas, and we have absolutely no intention of doing that. But I think sticking to our knitting is important right now.
There's been a real big conversation that the reason you've seen a lot of the giants of this space go into other areas is because there's been real fee compression. And that in order to succeed, you need to asset gather when fees aren't as robust as they once were.
Yes.
Is that a troubling trend if we are moving into the commoditization of private capital?
Yeah. I think where you're seeing more of that is in the BSL market, right? In the large cap companies that now have a syndicated option and a private credit option, right? So the private credit lenders that are moving into that space are actually competing with the syndicated loan market. So you've seen compression in spreads in the large cap market. Today, core middle market, what we do in traditional private credit, has about a 200 to 250 basis point advantage over the syndicated market. And I think a big reason for that is that compression of spreads we're seeing in the BSL world. So we like our space better, I would say, overall. But you're right. The largest private credit managers that are going into that space are competing with the syndicated loan market. Therefore, there's a lot more competitive dynamics that they're running into versus the core direct lending market, where, frankly, delivering $300, $400, $500 million solutions, there are a fairly limited number of firms that can do that. So we like our space a lot, but you're right. As you get into the larger deals, it's a much more competitive dynamic.
Ken, we appreciate you joining us on Open Interest, even on a day when Romain is here. Romain Bostic and Kate Ryan.
Actually saw him earlier, so
they'll be anchoring. They'll be anchoring the close at 3 p.m. A show you don't want to miss. Ken Kencel there of Churchill Asset Management. Still ahead, inside on the luxury market, Bentley's CEO joins the show to discuss the new Continental GT Supersports. This is Bloomberg Open Interest. Let's get a check on what's going on in the markets right now. We have the S&P 500 down 0.2%. That's enough to drive us to a weekly loss, so the second loss in a row in terms of weeks on the S&P, and that is the worst that we've seen since early summer. Coming up, the latest generation of the Bentley Continental GT is out, the Supersports edition, and the CEO of Bentley joins us next, as well as my Hot Pursuit co-host, Hannah Elliott. All right, let's bring in Bloomberg's Hannah Elliott, our luxury correspondent, normally on the left coast, and she is also my co-host on the podcast, Bloomberg Hot Pursuit. Fresh off the global debut of Bentley's brand new Supersports, and this thing is a shocker. It's lighter, it's louder, it's rear-wheel drive, gas only, a bruiser from a company that has been adding weight, all-wheel drive, and leaning into electrification. So, Hannah, you were there last night. What did Bentley just unleash?
This is a big tease about what we can expect to see more from Bentley, I think. Of course, it's been about a year since Frank Walliser, the CEO, joined the company. As you know, Frank came from Porsche Motorsport, where he was the mastermind behind a lot of race wins. This is the first car that really has Frank's thumbprint on it. It's a big indicator that Bentley is doubling down. It's going to get a lot more boy racer. I think. I'm excited. As a boy racer myself, I'm very excited about that. The man behind the madness is with him. Frank-Steffen Walliser is Bentley's relatively new CEO. He's been on the job a little over a year after a storied run at Porsche, where he didn't just win races, but he developed the 918 Spider supercar, which is one that we were looking at in the editorial meeting yesterday and all in awe of. He joins us on set. Hannah dragged you in here after the debut, so thanks so much for joining us. What is happening? Are you bringing Bentley back to its driver car roots?
Yeah, definitely. I think that describes it pretty well. Bentley is and was always the driver's brand. And I'm joking a little bit because our club of fans is called Bentley's Drivers Club. So, to underline this, and needs the right product for it, and we feel it's really beneficial for our brand. If you can drive it, and the thrill of driving is a core of our brand and of our DNA, and it was for many, many years. And we said, yeah, let's make the products that even underline it more. And we had some fun by putting this car together and developing it and bringing it to life.
I remember when Hannah last year at some point did a story where she went out driving with you. In the Continental GT Speed, right? And I remember saying, like, everybody is watching Frank now, and they're going to wait for the first car that he develops because of your track record at Porsche, right? Is this the first vehicle that has your imprint on it?
Yeah, definitely. Well, the story started honestly at day 2 when I joined Bentley, and we had what we call the product roundtable. That is I would say, of official meetings, gathering of engineers, sales, marketing, design, finance, and we talk new ideas in an open space. Normally in the evening, takes sometimes hours, and it's very open. And this was the second day, and I joined it, and there was the idea around what can we do on Continental, and I said, yeah, let's go for it, but make it, please, as extreme as possible. And I brought a little bit of my experience in, but the interesting thing for me was in Bentley, it was always there. I just really had to ignite it. And then people immediately know what to do and what to go for. And they really went above and beyond, timing-wise, content-wise, what's possible, engineering capabilities, really great through the whole company. So it really defined not only a new car, but also a new spirit in the company.
Frank, I know we've made so much about this as a V8, and especially that this is a non-hybrid vehicle, but I also know you guys have some electric vehicles in the pipeline as well. So what's the balance at Bentley going to look like between EVs and then internal combustion in the future?
Well, looking at regulation, looking at how the market splits up, I think it's even more important than it was in the past to offer a balanced portfolio. So I'm very proud, and one of our next announcements will be the next Bentley. So we add another car, what is in general great news, and yes, it will be electric. And so customers of Bentley have the choice between plug-in hybrids, pure ICE engines, and an electric car. And also the electric car will be a driver's car, beautiful designed, tech-wise on a next generation. So a big choice for our customers, and I'm sure it will bring customers to the Bentley brand that would have never considered us.
You know, I'm really curious about that as we move deeper into tech. How does Bentley still define luxury in this space where you're going, okay, we're going racing, seems like, and we're doing tech? Where does luxury fit into that?
I think luxury comes with many aspects. One is definitely the engineering, the craftsmanship behind it, what we can offer, and this is maybe also a sweet spot for Supersports, because it offers you really the thrill of driving, and I had the chance to drive the car on racetracks in Spain. It's really a difference if you drive that car. But it comes with all the craftsmanship, with the leather, with the quality, with the Bentley, with the reliability of a Bentley. And that's a sweet spot in the market. And tech gets more and more important, but it has not to be mixed up with that. And we see some, especially Chinese, but also US tech players, but they are tech offers. They are not luxury brand. And I think that's a difference. It's sometimes mixed up. And we have a very clear position on the luxury side, sporty interpretation of the luxury side, but we will not chase down our colleagues from Porsche or Lamborghini for lap times. We're in a different league.
Frankie,
grown up.
I love that. So you've also had to relocate to England, where the bulk of the Bentleys are being assembled. There were comments from the Ford CEO saying that he had thousands of mechanic job opens that they couldn't fill. Obviously, a very different offering for the people who are going to be working on a Bentley versus a Ford in a different region, America versus England. But how difficult is it in this very moment where the UK is facing some of those pressures, too, of getting the skilled labor that you need to assemble these cars?
We are in a very good position. We are recognized as one of the top employers in the UK. We are still very attractive. I think the offer, the packages we have for our employees, for our workforce, is really attractive. We have a lot of people that working there second and third generation. So it's very clear for family members, they work in Bentley. And so a high loyalty of our workforce, and I think this brings us in a good position. For sure, we're also part of to get the best talents then on the tech side, engineering side in the country. But at the moment, I would say it's not really a problem. We're well positioned and works pretty well.
What about the rare earths and the microchips? Ever since the supply chain debacle of the COVID crisis and now the trade war with China, I was asking Mark Royce of General Motors, obviously a very different car maker, but
same semiconductors.
Well, exactly. So he was saying what they really try and do, among other things, is engineer some of that stuff out so that they aren't reliant on it. Is it the same at Bentley, at Porsche, in the Volkswagen Group?
It's considered to be in the Volkswagen Group. Partly you can engineer it out, rare earths, but not everything comes with an advantage, so you have to balance it. On the semiconductor side, for sure, Volkswagen has a big network, and after the post-COVID semiconductor crisis, a lot of processes within the Volkswagen Group have been set up to respond to such a situation, and this is what now happened. And in comparison to the last chip supply shortage, and Now it was politically because someone said no, and then it stops immediately. It was not a factory or a shortage of any pre-material. But the processes that have been set up brought us in a position to, within hours, we knew which cars, which factory, which parts. And then you could immediately respond. It was less complex semiconductors, so you could work around. And so far, we managed everything, so we have no shortage, we have no impact on manufacturing. And it looks like it's sorted now, with supply is coming back again. So it just showed also how resilient Volkswagen in total was. And for sure, in the Volkswagen group, there's a high likability that if there is a semiconductor available, Bentley will get it, just on the contribution of our cars.
Of course, of course. I wonder about the effect of tariffs, because I've noticed kind of a split among luxury car makers when I talk to Benedetto Vigna. Okay, it doesn't matter so much to Ferrari buyers. The same is true when we talk with Stephen Winkelmann at Lamborghini, although, you know, they are going to have to raise prices and it's maybe a little more sensitive. Meanwhile, at Aston Martin, it's a real problem, right? Maybe because their prices are too high to begin with. But what is it like for Bentley buyers, and how are you dealing with passing those prices on?
It's, well, we looked, and you react on your pricing side every model year, what we did with the 26 model year. And I think we can deal it at the moment. But I would consider, in general, the market conditions have the bigger impact than the tariff impact. UK and US have a very, very good tariff agreement, so there's no complaints. It's the best in the world. To be clear, it's 7.5 more, so it's 10 in total. It used to be 2.5, so it's 7.5 more. Definitely something we can handle. We don't see really an impact on it. But the market is not as good as it used to be. I think it needs a little bit more stability again in the US and a little bit better outlook. You just talked on the development of the stock market. That does not help. But
will rate cuts help? Do rate cuts matter to Bentley?
Yeah, we'll see. At the moment, it's a lot about the sentiment.
All right.
Frank, but I'm in good mood. It will come back and it'll work.
Yeah, everything's going to be okay, dude.
Yes.
Frank-Steffen Walliser there, the CEO of Bentley, along with my co-host on Bloomberg Hot Pursuit, Hannah Elliott. For all things autos, listen to Hot Pursuit, which can be found wherever you get your podcasts. And after this show, we're going to take Frank into the studio, and we're going to sit him down and talk to him about all things Bentley, and it's going to be fantastic.
And you know what else?
Regardless of what's going on in this market.
But things are getting better. So, Frank, you might be happy about this. I mean, it's still red, but it was deeply, deeply red to start the hour. Maybe Frank turned things around. People are willing to buy more Bentleys now. We are down about 0.1% for the S&P 500. The NASDAQ now flat, Matt. It was leading losses for this equity market. It has turned around after the destruction of AI stocks this week. People are willingly buying it, despite the fact we've also had a lot of hawkish Fed speak over the past couple days.
Yeah, it has been, well, not as much of a sure thing as it looked like previously. We showed the chart earlier that our producer in London made, Dan Curtis, which shows the full amount of percentage point rate cuts that now priced in by the market.
It's kind of like a coin flip for December now versus...
Right, so it's like 12.5 points instead of a full 25. Right. Not that the Fed will do that. That's something that the ECB would try. Let's get a look at some of the single stock stories this hour. Stubhub did not provide a forecast for the current quarter in its first earnings report since going public in September, and a forecast is something that shareholders typically like to see, especially in this kind of business where they should have a great outlook in terms of ticket sales.
A good way to lose a quarter of your value in one day. A rare gainer today, Gap. It was raised to a buy at Jefferies. They see encouraging trends that should help top and bottom line growth.
And Merck & Co. agreed to acquire the biotech company Cidara Therapeutics, which is developing a flu treatment, and that premium is enough to double the company's stock price.
Coming up on the show, it could revolutionize everything from drug discovery to finance. Wall Street Week takes an inside look at the race for quantum computing. That's coming up next. You're watching Bloomberg TV. time for our Wall Street Week conversation. Einstein doubted that it could exist, but nearly a century later, quantum mechanics is driving one of the biggest tech races of our time. David Weston explores how quantum computing could change everything.
Companies like Google, Microsoft, and Intel are all exploring the potential of quantum computing. But there's also a new group of contenders, startups, that are betting it all on the hope that quantum tech will one day become profitable. One of those firms is Maryland-based IonQ. Its CEO is Niccolo De Masi, who believes he has the best horse in the race.
We supply quantum computers to our both federal, state, and commercial customer partners. We also provide quantum key distribution, and we do that both on the ground and up in the heavens. Quantum key distribution is effectively quantum cyber security. And we're very focused on this not being just proof points in the lab, but doing useful quantum advantage examples for our customers and embedding ourselves into their workflows on an ongoing basis.
So what will it look like as we go beyond showing so-called quantum advantage in the lab and embedding it into real-world workflows? One place people look to first is in the life sciences, work like Dr. Garcia is doing at the Cleveland Clinic.
An example of something that we've done is we've taken some of the algorithms that we've worked on for chemistry, and alongside Cleveland Clinic, we've started looking at different chemical processes that they really care about. So you can think about this in the larger context of, therapeutics design, drug discovery, that kind of thing. And really what we're doing with Cleveland Clinic is pushing the boundaries of algorithm development, methodology, of using quantum computers, again, in concert with classical computers to come up with solutions to problems that they care about. Protein folding is definitely one area, mRNA, secondary structure understanding, how things like come together and how they look in sort of 3D is a very interesting area, as you can imagine, as you're trying to understand how these things fit together in a biological system.
It isn't just life sciences that could be revolutionized by the addition of quantum computing. Financial markets are another target of opportunity. IBM scored an early advantage this year when HSBC said it used the tech company's Heron quantum processor to make a 34% improvement in predicting how likely a bond will trade at a given price.
I think there's a lot of excitement in the market space as well, right? Especially because optimization is certainly in another area which we know is a classically difficult problem. And from the point of view of actually using a quantum computer to address optimization, there are many threads there in terms of leveraging this kind of large exponentially computational space to handle problems such as portfolio optimization, right, or risk management, right? So there's a lot of interesting ideas there that are being looked at by various financial institutions.
That was David Weston on quantum computing. Catch Wall Street Week tonight and every Friday at 6 p.m. New York time. Coming up, Cantor Fitzgerald scoring a record year with Kyle and Brandon Lutnick at the helm. We'll get you the details next with Todd Gillespie. This is Bloomberg Open Interest.
Brandon and Kyle Lutnick are putting their stamp on Wall Street with Cantor Fitzgerald set to notch a record year under their leadership. Bloomberg finance reporter Todd Gillespie joins us now. I guess not just their leadership, but the many co-CEOs that are also at Cantor Fitzgerald. This one, you spoke to them. This one from Sage Kelly, one of the co-CEOs. I promise you, we're not getting anything handed to us. How much of the success of Cantor Fitzgerald is because of the leadership of the Lutnick boys versus closer ties to Washington, D.C.?
Well, Dani, I mean, if you speak to these guys, and we've got an exclusive interview with them out today. I mean, what they will say is that a lot of their successes that's come this year, a record year for them, is largely down to a lot of the preparation for years and years under Howard Lutnick himself before he went to Washington, D.C. to push into sectors like crypto, like robotics, like quantum, like AI and data centers. The firm had a big conference around these issues earlier this week in Miami, where I was, and a lot of these guys will say to you, look, another good quote by Christian Wall, one of the CEOs as well. He said, you have to get through the winter to get to the spring. And he was sort of saying, there's this crypto winter for years under the Biden administration, but these guys have kind of carved out a niche in sectors that bigger Wall Street banks had kept at arm's length for years, and now they're just reaping the benefits of that kind of preparation.
The thing is, if I were, for example, a convicted felon looking for a pardon, I would probably hire one of the lawyers close to Donald Trump. And if I'm in an industry that needs sort of regulatory help in the administration, I'd likely do my deals with Cantor Fitzgerald, right? Doesn't it just make sense?
Well, I mean, I think one could argue that a lot of the Wall Street banks now still do have ties to the administration. One can speculate here. Obviously, this company is saying that, these guys are saying that they're very much, independent. They're running the firm as they would anyway.
Of course they would. I'm just saying from a client's perspective, right?
Sure.
You'd like to be closer to Howard Lutnick because he is the Commerce Secretary.
Yeah. And I mean, certainly as well at this conference that we had names like Eric Trump and Ted Cruz were also present speaking on panels. Bear in mind, Ted Cruz is also the one who's running the committee in the Senate that scrutinizes Howard Lutnick's Commerce Department. So, at the same time as trying to keep their distance from the administration, it is a firm that is embracing business and politics mixing just like any other firm on Wall Street under the Trump administration right now. But you're right, to some degree, there are firms that are aligning themselves with sectors that are certainly cozier and closer to the administration's agenda.
How does running this firm even work right now? If you have Kyle and Brandon Lutnick, and then you have the 3 co-CEOs, how is leadership split between them?
So you have Cantor Fitzgerald Group, which is actually split into 3 main holdings. There's the private Cantor Investment Bank, which is run by these 3 co-CEOs, but also with major shareholdings separately in Newmark, the big real estate group that Howard Lutnick acquired years ago, and BGC, which is a big brokerage, which is split between New York and London as well. So these 3 guys, these co-CEOs manage the core of that business. Brandon and Kyle kind of are sort of chairman, co-CEO, executive vice chair of the parent company as a whole, and also manage those other interests as well.
But when Brandon and Kyle go to dinner at the White House, are they doing so as sons of the Commerce Secretary or as leaders of Cantor Fitzgerald?
It's a good question, Matt. I think that technically you would say that Brandon Lutnick went to dinner at the White House this week along with David Solomon, Ken Moelis and co. As the CEO of Cantor Fitzgerald. The fact that his father was at that dinner, one might ask questions understandably, but as a Wall Street bank that is pushing into some of the administration's most favored sectors on a business agenda, you might have to ask Donald Trump that question.
All right, Todd, great story, really fascinating read. Todd Gillespie covers finance for us on the Bloomberg News side. Let's get a check of what's going on in the markets as we approach the end of the first 90 minutes of trading. We're looking at an S&P that is now unchanged, a NASDAQ that is now gaining. So what started out as a very dour session in futures with a drop of more than 1% on the S&P and almost 2% on the NASDAQ has completely turned around. It looks like investors are buying the dip. Coming up on Monday, Jack Janasiewicz of Natixis, credit power player Chris Sheldon of KKR, as well as the CEO of Stagwell, Mark Penn, on his partnership with Palantir. This is Bloomberg Open Interest.